Craig Bolanos joins us right now. I love chatting with Craig. Probably one of the more optimistic guys you'll chat with. He's a co-founder and wealth advisor at VestGen Wealth Partners. Craig, happy sunny Wednesday, my friend.
Well, and why shouldn't anybody be happy? Come on, new highs make new all-time highs. 45,000 on the Dow, almost 6,500 on the S&P. The sun is shining. The rain has abated. Inflation's comme ci, comme ça. Rate cuts, we get them in September. John, life feels okay.
Yeah, okay. I'm going to give you most of that. I don't know about this inflation picture and this jobs picture. And I just feel like, look, I'm not an economist, right? And I get the need and desire and want and like feel like we've earned it, the rates cut that has been stalled for a while. But like, no one's worried about like a little secret thing called stagflation potentially there if the jobs number comes in poorer again. Maybe we get more downward revisions. I mean, who knows what we're going to get with the jobs number when we actually get it. And the inflation was fine, but the core inflation was peaking up and maybe more coming down the road. I'm not trying to be a bummer here, Craig. I'm an optimistic guy too, but is no one seeing what I'm seeing?
Okay, let's break those down. But let me just remind everybody that in the short term, which is what I talk about often on your radio program, John, is this. As long as the macroeconomic backdrop, which is trade clarity, continues, and we know we're settling around 18% effective rates, as long as the Fed does give us the rate cuts the market's pricing in September and December, as long as GDP, look at it, it was good, remained stable, and earnings, I don't know about you, with the exception of a couple of companies, earnings have been solid. All of that renews the ideologue that people have of readopting Trumponomic. Maybe it feels a little euphoric because that's what drove markets in late 24, drove markets in early 25, and it's been driving us in June and July. What you want to talk about is this, Goldman Sachs, PNC, a number of companies saying, hey, no one's going to have runaway inflation, but if the monthly gains are around 0.3% per month going forward, that'd be a 3.6% print. That's higher than where we are. It's inevitable the consumer's going to feel it. And if the consumer slows down their spending a bit, then we will start to see some marginal layoffs.
What about jobs, Craig? I mean, I'm not trying to poo-poo an economy that 2 weeks ago I was like, well, we're in the Goldilocks, right? It's a vibe thing sometimes with people, and I fall victim to that as well. I don't know. The jobs picture's fine, I guess. I mean, I want a second data point or a third data point to really kind of ascertain where we're at here.
Well, what I tell everybody is this. 1 month of bad job prints with revisions, no one likes the revisions, but we get them all the time, is not a new trend. But, John, you and I have talked before that in this country, the unemployment rate on a long-term average runs 5.7%. The unemployment rate the last 30 years runs 5.2. We're still well sub 5%. So I fully expect, as does the Fed, that the unemployment rate, which has been in a tight range for 12 months, 4% to 4.2%, I fully expect that to incrementally grow to 4.3 to 4.4 to 4.5 to 4.6. Heck, John, the Fed expects that too. Why else would they talk about cutting rates with CPI still a little bit elevated relative to their target? But that doesn't mean the stock market can't continue to grow. That doesn't mean the economy is going to roll over. It's not Goldilocks, but it's still a pretty good recipe with a sub 5% unemployment rate.
I mentioned that lowering the rates is like a reward, and that I do think that people are just craving it so much as just that we've earned it. This economy has done well. The plane landed, and it has done well. It's the envy of the world what it's been able to do lately. I'm of the mindset that I want the Fed to have as many tools in the tool chest that they need if things go a little sideways. And maybe just lowering it 0.5 point isn't going to really matter all that much, and you can always raise it back up 0.5 point. But Craig, I just worry we're in an era now where like we are so used to the low interest rate being so low, and oh my gosh, into the 4s, my goodness. I mean, that's pales in comparison to what it used to be. I just worry that the Fed is losing options moving forward if they precipitously drop the rate like the administration wants them to.
Well, I think the Fed is not going to do what the administration wants. The administration's been barking at the Fed for how long? We know we're eventually going to need a new Fed chair, but I think the Fed's been doing the right thing. You could have made an argument that in advance of some additional job loss, which I am predicting, John, that the Fed should have cut rates already. But why didn't they? They wanted to save their ammunition. They wanted to save those rate cuts to see what, if any, effect tariffs are going to have on consumer prices. That's why they're delaying. And I think the Fed is going to give us not big cuts. I mean, I saw the Treasury Secretary ask for 1.5 to 1.75% cuts as quickly as possible. We're not going to get that. We're going to get a little bit of Tylenol. Tylenol is responsible. Small doses of stimulus, small doses of easing in September. Again, a follow-on act, I hope, by December. And if you do that with the big four remaining that I mentioned earlier, this market's got room to remain stable, but for investors, there's no room for complacency, and that's why I hope people are rebalancing.
TNT, Tylenol in the trenches, Craig.
That'd be a new one. Tylenol in the trenches instead of tested in the trenches. And you know what, John? That's what I want people to do. I do want people to take some Tylenol. I do want people to make sure they're not letting the equity portion of their 60-40 stock-to-bond ratio get too high. Rebalance, everybody. Buy muni bonds. They're totally on sale. I think people should also be buying real assets for storages of value. I think people need to be diversifying their diversifiers at this stage in the market cycle, because trees don't grow to the sky. Despite my optimism, you got to focus on price, and there's a lot of stocks and a lot of value out there. It's not just tech and it's not just Meta.
I'm glad you mentioned that, because I feel like your optimistic outlook, which is, I always love it, Craig. It feeds me an energy that I sorely need sometimes. But when you sit down with clients and customers of yours and people you work with, that optimism comes with a dose of reality when you actually lay out a plan, right? It's great to be optimistic, but it's important to be checking the blind spot.
Yes, you have to have. If you want to get retired and stay retired, you have to have a data-driven investment process. Otherwise, you too could be left on Recession Island years ago when people thought the sky was falling. Also, a data-driven process is going to allow a client of VestGen Wealth Partners to future-proof, because you've got to future-proof to eliminate the risk. The risks are taxes in retirement. The risks are currency inflation, or in some cases deflation. You've got to have plans to address all of those blind spots, because people should always be worried not of what's in the news. They should be worried about what's not in the news. And if you can take small doses of preventative medicine to cure those, it's going to make your retirement journey so much more sustainable.
GetRetiredStayRetired.com. Craig, you're awesome. Thank you, my friend.
Great to be with you.
I could ask him anything out of the blue, not prep him for a thing on the economy. He'd give you 6 minutes on it, and he'd be great at it. Let's take a break. We got the news